All right, welcome to another session of the My Solo 401k Financial Weekly YouTube series. We're about to get started with some great content. All right, today's session is focused on the Solo 401k deadline to open and contribute for 2024, specifically focused on a business that is taxed as an S corporation or an LLC taxed as an S corporation. If you're on YouTube, please don't hesitate to chat over questions or topics that you wish to discuss, or could be related to this topic or even unrelated topics. Once we go through these slides, we will go through all the questions sequentially. So thank you so much for taking the time to join. Please like and subscribe if you're on YouTube. We want to highlight the resources because we do host daily live office hour style Zoom calls on our community, Monday to Thursday, 1 p.m. Pacific, 4 p.m. Eastern. On Friday, we like to come to YouTube with some prepared content like we are today. It's always free to join. All are welcome on our community. We also have forums where folks are posting questions 24/7, as well as a library of videos and webinars. So we have a lot of great ways to learn and to share the knowledge. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So before we jump in, I think it's going to be super helpful to just lay the foundation, discussing solo 401k eligibility, some of the other foundational topics. So a solo 401k is a plan for an owner-only business. So a self-employed individual with no full-time W-2 employees, so that the individual could have a spouse and still be eligible to set up a solo 401k, but you can't have any non-owner, non-spouse, full-time W-2 employees. So think like an independent contractor, a solo practicing professional, could be a realtor, a CPA, an attorney. In terms of some of the top eligibility considerations, you do not need to have a formal legal entity. We have many clients who operate as sole proprietors, which is totally fine. They could have an LLC or an S-corp, but they don't need it to be eligible. To be eligible, you need to report earned self-employment income on your taxes. So for example, Schedule C for a business that's taxed as a sole proprietorship. W-2 wages for a business that's taxed as an S-corp. There's no minimum amount of earned self-employment income that you need to report in order to be eligible to set up a plan. But of course, if you don't report relatively very much self-employment income, you wouldn't be able to contribute very much, because your ability to contribute depends on your income, right? You can't save more than you earn. Your spouse or business partner may participate in the plan as long as your spouse or business partner is reporting their own earned self-employment income, such as their own Schedule C or their own W-2 from the business. Now, you may have a solo 401k even if you have a W-2 job, right? If you have a side business, even if you participate in your W-2 employer sponsor plan. Again, as long as you've got that separate earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. So to continue to paint the picture as far as what a solo 401k is, it's helpful to understand why people are setting up solo 401ks. So why open a solo 401k? Well, there's some great use cases out there. And to understand these use cases, let's look at it through the lens of the user. So here we have the frugal investor. So setting up our solo 401k plan will make the self-employed individual or their business eligible to claim $1,500 in solo 401k tax credits. That's $500 per year for 3 consecutive years. So that's going to more than cover the cost to set up and maintain the plan for the first 7 years. Our fees are $650, which is the initial fee. That includes the $525 establishment fee, plus the first $125 annual fee. Starting 12 months later, we charge our $125 annual fee that covers the second year. Another great use case is the Roth Maximizer. So for someone that's looking to maximize the amount of money going into a Roth account, our solo 401k plan is a great vehicle for that. For example, the individual may be able to contribute up to $69,000 or even $76,500 if they're 50 or older between Roth and Mega Backdoor Roth contributions. Moreover, the plan would allow them to convert pre-tax retirement money that they already have. Could be in a former employer plan, could be in an IRA, could be pre-tax contributions that they make to the solo 401k, but convert as much or as little as they want from a pre-tax status to a Roth status. Now that's going to be taxable for the year of the conversion, as well as reportable, and we handle the required 1099-R to report that in-plan Roth conversion as an optional free service for our customers. But then going forward, they would have the potential for tax-free growth. Another great use case is the large account holder. So once the value of the plan exceeds $250,000, there's going to be an informational tax filing requirement, which is called a Form 5500-EZ. Now, we handle that Form 5500-EZ as an optional free service for our customers. In other words, no additional charge. In addition, we do it under the electronic filing system, the EFAS system, to make it easy for the customer. The next use case is the alternative investor. So, of course, our plan allows for typical brokerage type investments. And as a matter of fact, we help customers open up free brokerage accounts at many brokerages such as Fidelity, Schwab, etc. Free meaning the brokerage is not going to charge anything to open the account. There's no maintenance free. They even offer free online trading to invest in stocks, bonds, mutual funds, etc. But in addition, our plan would allow the self-employed individual to invest in true alternative investments, whether that's real estate, private placement, private stock, crypto, precious metals, or notes. Finally, the rainy day investor. So with our plan, the self-employed individual is going to be able to take a loan and then use those proceeds for any purpose whatsoever, including a personal purpose. And that loan is not going to be subject to taxes or penalties as long as it's, number one, within the loan terms, as well as documented as a loan. And we handle the loan documentation as part of our service for no additional charge. So those terms would be the individual would be able to borrow up to 50% of the balance, not to exceed $50,000. It would need to be paid back in either monthly or quarterly payments, equal payments of principal and interest, the interest being prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. So now let's turn to the deadlines. So as mentioned, we wanted to discuss the setup deadline as well as the contribution deadline, specifically focused on a business that's taxed as an S corporation, could be an LLC taxed as an S corporation. So if someone doesn't already have a solo 401k plan, but is looking to make 2024 contributions, the great news is that there's plenty of time to both set up as well as make those contributions. And we make it very easy to meet these deadlines. So for example, if someone were to sign up with us, because that's what it means to set up a plan, is to sign up with us. If they sign up with us by the end of the year, that'll give them the most flexibility, both in terms of the type of contributions that they can make, as well as the most time to make those contributions. So if they sign up by the end of the year, they'll be able to make all types of contributions, whether it's pre-tax and Roth, employee or employer. Our plan allows for both. And or if they want to make voluntary after-tax contributions, which is how one makes Mega Backdoor Roth contributions. Now, if they sign up with us by the end of the year, that will preserve the ability to make contributions all the way up until their self-employed businesses tax return deadline. So for a business taxed as an S corporation, that's going to be March 17th of next year or September 15th if they file a timely extension. Now, if they wait to set up the plan next year, they're still going to be able to make 2024 contributions, but not as many types. So they wouldn't be able to make the employee contributions, but they could still make employer contributions and or voluntary after-tax contributions. So if they sign up and set up the plan by March 17th, they're going to be able to make contributions by their tax return deadline, March 17th, or a timely filed extension. So if they wait until after March 17th and they file a timely extension, that'll give them more time to both set up the plan as well as make either employer or voluntary after-tax contributions. So in other words, if you don't sign up by the end of the year, you'll lose the ability to make employee contributions. So if you sign up next year, you'll still be able to make employer or voluntary after-tax contributions as long as you sign up in time to be able to make either of those contributions by your business tax return deadline, including any timely filed extension. So as I mentioned, we make it very easy to meet the deadline. What does it mean to meet the deadline? Well, what does it mean to set up a plan? So to understand that, I think it's helpful to understand that a solo 401k is really a legal entity. It's a trust. So like any legal entity, it's the documents that create it. So we create those documents within the same day when someone signs up, and all they need to do is sign the documents to meet the deadline, to set up the plan. So the individual will just complete our online application, just takes a minute, make payment. Then we'll add the plan to the queue. We'll prepare the documents within that same business day. An email goes out with a link to our secure portal where the individual would be able to access the documents from the secure portal, all pre-filled out specifically for their business, download, sign, and they've met the deadline, right? They don't need to return the documents back to us. They don't need to open accounts, et cetera, et cetera. That can all wait until next year. So completing those steps by the end of the year, as we talked about up above, is going to maximize all the different types of contributions that can be made and the time that they have to make those contributions. So they're going to be able to make employer contributions for 2024 and in 2025, as well as voluntary after-tax contributions. They're going to be able to open up accounts next year. They can, of course, fund the accounts as long as they do it by their business tax return deadline, including any timely filed extension. So to just dig into these requirements a little bit deeper, right? As mentioned, we have just a quick 1-minute application to just gather the information that we need to create the solo 401k documents for your business. An EIN number will need to be obtained for the 401k, but that can wait until next year when you're ready to open up the accounts, so that those accounts would be opened up under the EIN number that's obtained specifically for the 401k. And we obtained that as part of our onboarding process. So once we get that online application and make payment, we draft the documents. So that's what creates the plan. That's what enables you to meet the deadline. We draft the documents specifically for the self-employed business. Again, that goes out with a link to our secure portal where they can just easily be downloaded. The cover email is going to specify where to sign them, sign the documents, and you've met the deadline. And then you can sign the documents, either with an electronic signature software if you have access to that, or of course you can just download, sign with a wedding signature, take a picture with your phone of the signature pages, and then take your time. You've met the deadline at that point for 2024. Take your time in 2025 to open up the accounts, et cetera. And then when you're ready to open up the accounts, clients just return back the signed and completed pages from that same email where we're giving them access to the portal. We take them to a page on our website where they let us know where they want to open up the accounts at, right? It could be Fidelity, Schwab, their local bank, et cetera. Based on their answer, then we would prepare all the paperwork, pre-fill it, right? For example, if they want to go with Schwab, we'd pre-fill all the paperwork to open up the requisite number of accounts at Schwab. Another email goes out where they can access those pre-filled documents to open up the accounts at Schwab, to sign the documents, upload them back to the secure portal. We then will review and compile, fax them to the back office. With Schwab, we can fax them right to their back office. And then an email goes out from Schwab to let the customer know that the accounts are open. Then they can start making contributions, right, to meet their deadline, which is going to be, again, the business tax return deadline, including any timely filed extension for all types of contributions, as long as they sign up with us by the end of the year. So some of the top FAQs would be, do I have to obtain an employer identification number by the end of the year? So the answer is no, right? All that you need to do to meet the deadline is to sign up with us, because then we'll create the documents within the same day. Then you can easily sign those documents and meet the deadline. So a separate EIN number will be needed for the solo 401k, that's the IRS expectation. And we certainly have always done things that way. And we would certainly do that with your plan. And then that EIN number will be used to open up the accounts for the solo 401k. But all of that can occur in 2025, right? There's no obtaining the EIN number is not a necessary step to set up the plan and meet the deadline. Do I have to open the solo 401k accounts by the end of the year? No, you don't, right? As mentioned, all that needs to be done is to set up the plan by the end of the year. You can open up the accounts, you can make the contributions anytime up until your tax return deadline or an extended deadline if you file a timely extension. Do you have to make both employee and employer contributions by the end of the year, by December 31st? The answer is no again, right? Again, all you need to do is sign up so that we can create the documents, you can sign the documents, and therefore set up the plan by the end of the year. So, and this is clear based on IRS guidance. For example, IRS Publication 560. We have an excerpt of that IRS Publication 560 here. There's a chart on page 3 that makes clear that the deadline for a defined contribution plan, IRS Publication 560, just to put it in context, is the landmark guidance for self-employed individuals and their retirement plans, such as solo 401k plans. And so the deadlines for self-employed individuals are later than the deadlines that someone might have for a full-time employer plan. And again, this is clear right from the IRS Publication 560. Here's the chart from page 3, that the deadline to set up the plan is by the end of the tax year. And then that'll preserve the ability to make all types of contributions, whether it's employee, like elective deferral, or employer by the due date of the employer's return, including extensions. And so another great question would be, okay, how can I make contributions based on income that I earned in January of 2024 if I don't adopt the plan until December? Well, the industry best practice is for that plan to be effective as of January 1st. So then that's going to set the stage and allow you to make contributions for any income that you earn and report for 2024, any self-employment income that you earn and report for 2024. So for example, for a business tax as an S-corporation, that's going to be the W-2 wages that you earn and report for 2024 from your self-employed business tax as an S-corporation. So super common that many individuals are setting up the plan by the end of the year, just so they lock in the ability to make contributions for 2024 anytime up until their business tax return deadline or a timely extension next year. And then they can use any income that they earn and report for their self-employed business for 2024 to justify those contributions that they end up making, sometime next year before the business tax deadline. A common question we often field is that my CPA tax advisor is informing me that the employee contribution must be made by the end of the year. Are you sure that I can make this contribution in 2025? And this is a common point of confusion for folks who might be coming from a full-time employer plan experience, right? Working, say, in corporate America, where for those full-time employer plans, that is certainly true. The employee contribution does need to be made by the end of the year. But the rules are different for a self-employed business, right, which may not know how much they've made until after the end of the year. It might be a seasonal business where they're working diligently all the way to the end of the year, don't know exactly how much they've made, therefore don't know exactly how much they're going to be able to contribute till after the end of the year. So the rules gives those self-employed individuals more time to make contributions. As we clearly saw from IRS Publication 560, as long as they set up the plan, meaning sign up with us by the end of the year, that'll preserve the ability to make all types of contributions, whether it's employee contributions, referred to as elective deferrals in the guidance, or employer contributions or voluntary after-tax contributions. They'll be able to make all types of contributions as long as they sign up by the end of the year, anytime up until their business tax return deadline, including any timely filed extension. So the question makes sense, but the difference is clear to understand, right? Why those rules are different. So you have more time. You have until that business tax return deadline. And so this is a great chart here at the end where we've got the different business types. It just really highlights that it's going to depend on how your self-employed business is taxed, right? So for a sole proprietorship, where your business tax return deadline is really your 1040 deadline. That means that as long as you sign up by the end of the year, your contribution deadline is going to be your 1040 deadline. So April 15th or October 15th, if you file a timely extension. All right. Thank you so much for participating and listening to the content. Again, if you have questions, you're on YouTube, please don't hesitate to chat it over. Please join us on our community, mysolo401k.net/my community. We host these office hour style sessions on a daily basis. We have forums, webinars, videos, lots of great ways to learn, lots of great ways to engage, right? You can, of course, ask your own questions, or another great way to learn is just hear what other people are asking. Okay, so then let's go through the questions. Thank you so much for bringing them. I had Vanguard individual 401k now transferred to a census. Will I qualify for the $1,500 tax credit? Great question. The answer is yes. So that automatic contribution credit, so the credit for including the automatic contribution feature, that is available to existing plans that add the feature. So your Vanguard plan that was transitioned to a census doesn't have the feature, but you can upgrade your plan to our plan, which for all new customers is automatically going to include the feature, and therefore make the self-employed business eligible to start claiming the credit. For example, when they file their 2024 taxes, they'll be able to claim a $500 credit, and then again for 2 more years for a total of $1,500. So we provide a wealth of resources to our customers, right? Including a webinar, a deep dive webinar that we hosted with an IRS enrolled agent that goes through step by step what needs to be done to be able to claim the credits, to make it easy for our customers. Great question. So thank you so much for the great participation. Please like and subscribe on YouTube. We'll be hosting this time of year. We like to host a lot of great content. We'll be back again next Friday with more content, and of course every day on our community. So you can always find us there. So we appreciate all the good participation. If I want to do a Mega Roth, how many accounts do I need, and who is making the contributions to the different accounts? So you need to have a plan like ours that allows for Mega Backdoor Roth contributions. Now, a Mega Backdoor Roth contribution is really a voluntary after-tax contribution. So you have to have a plan like ours that allows for voluntary after-tax contributions, and then an in-plan transfer, which ours does, either to a Roth solo 401k account or to a Roth IRA. Now, theoretically, if one only has voluntary after-tax funds in their solo 401k, so they don't have pre-tax money, right? They didn't make pre-tax contributions. They didn't roll over pre-tax funds from a pre-existing account like an IRA or a former employer plan, and they just want to transfer those funds out to a Roth IRA. They don't want to transfer any funds to their Roth solo 401k account, don't want to make Roth contributions, don't want to move money to the Roth account, either from the pre-tax or the after-tax. Then they could theoretically just have one account, their after-tax account, into which they make those voluntary after-tax solo 401k contributions. But if they want to have different types of funds in their solo 401k, pre-tax and or Roth, then those different types of funds need to be held in different sub-accounts. Now, of course, as part of our services, as we're onboarding customers or even existing customers that want to start making different types of contributions, right, we help them open up the requisite number of accounts at the bank or brokerage of choice. And then, since they're trying to make Mega Backdoor Roth contributions, where there's really going to be a 2-step process, right? First, the voluntary after-tax contribution, and then the transfer from the voluntary after-tax account to either the Roth 401k or the Roth IRA, that the contribution is not reportable, but the subsequent transfer to either the Roth 401k or Roth IRA is reportable. It needs to be reported on a Form 1099-R. We handle that as an optional free service for our customers. We have an online form that customers use to provide us the information that we need to prepare that 1099-R. Great question. Thank you so much for bringing it. Is it a voluntary transfer from the employee or employer? So if you're making the contribution to the solo 401k, right, you're depositing non-retirement money into your solo 401k account as a contribution. From a solo 401k perspective, that contribution can come from either the personal account of the solo 401k owner participant or their business account if they have a separate business account. We can't say from a solo 401k perspective that it has to come from one or the other. Now, technically, a voluntary after-tax contribution is a type of employee contribution, just to be clear. Next question. And can I use money from a beneficiary IRA to be the voluntary contribution with the tax implications from the beneficiary IRA? Well, you cannot satisfy the obligation to take a distribution from your beneficiary IRA by contributing it to the solo 401k. But if you have the self-employment income to justify the contribution, you can really take any non-retirement money that you have, right? Since money is fungible, to fund that contribution. So you have to have the self-employment income to justify the contribution. It's got to be within the limits. And then you would transfer it from either your personal account or business account into the voluntary after-tax solo 401k sub account. So the fact that you prior to that transaction might have taken a distribution from your beneficiary IRA is definitely a totally separate and distinct transaction. Has nothing to do with making contributions to the solo 401k. My wife and I own an LLC, not a corporation, and make $70,000 each. Can we each max up to $69,000? So I'm understanding that you're self-employed. You have an LLC, taxed as an S corporation. There's no non-owner, non-spouse W-2 employees, and you each receive $70,000 of wages from the S corporation. Let's assume you're under 50, just for discussion purposes. So the question is going to become, okay, what type of contribution are you looking to make? So if you're only looking to make voluntary after-tax contributions, and you could decide to just make voluntary after-tax contributions, you're going to be able to contribute 100% dollar for dollar of your W-2 wages as a voluntary after-tax contribution. But if you're trying to make other types of contributions, then there's different limits. For example, the employee contribution limit for 2024 is $23,000. You can do 100% of your W-2 wages from your business, taxed as an S-corp up to $23,000, assuming you don't make contributions to another plan like a day job plan. You can make an employer contribution to the solo 401k equal to 25% of your W-2 wages. So that'd be 25% of 70,000. And then again, the voluntary after-tax contribution limit is 100% of those wages, dollar for dollar, up to 69,000. Keeping in mind that the overall limit, right? The sum of all the contributions that you make to the solo 401k can exceed the lesser of your self-employment income, in this case, 70,000, or the overall limit, 69,000. So yes, if you make the full voluntary after tax of 69, assuming you don't make any other contributions to the solo 401k, assuming you each have $70,000 of income, then that would be totally acceptable. If my solo 401k is maxed at 69 and I take 20,000 from the solo 401k to the Mega Backdoor Roth, can I contribute 20,000 into the solo 401k, or did I reach my limit when I met the initial 69? Yeah, so you met your limit when you did the initial 69. Like, let's say you had a fair amount of W-2 wages from your business, and between your employee and your employer contributions, you already contributed $69,000. You're not going to be able to contribute any more as a after-tax contribution, which is how one makes a Mega Backdoor Roth contribution, because you still have to consider that after-tax contribution when you're determining whether you've met the overall limit, which you already have, assuming you're under 50 years of age. Once we make the 100% voluntary contribution of 69, can we then convert to the Roth? Yes. So it's a two-step process. You first deposit into the voluntary after-tax account before you move over to either the Roth solo 401k or Roth IRA. Here's the procedure page for making after-tax solo 401k contributions and then transfer into a Roth 401k. Let me grab the procedure page for transferring to a Roth IRA. If I'm also a W-2 with a large corporation, not my business, can I also contribute to the 401k there? Yes, you can. Keep in mind that the employee contribution limit, though, for example, 23,000 applies across all the plans that the employee participates in. So if that employee maxes out contributions to a day job plan, they're not going to be able to make any more employee contributions to the solo 401k. But the voluntary after-tax contribution limit of 69,000, like in your case, is not reduced by contributions made to a day job 401k plan. So you could make the $23,000 employee contribution to your day job plan, and then if you have the self-employment income to justify it, another $69,000 on top of that is a voluntary after-tax contribution to the solo 401k. So feel free to post it, or also feel free to book a call. Thank you for participating. There's our calendar link. Oh, there's your post. Thank you. I run a company in the motorcycle industry and reported an 1120S. It is set up as an LLC with an S-corp election. So if you don't have any W-2 wages, you don't report any type of self-employment activity. I mean, it could even just be a minor amount of wages or Schedule C income, for example. Then that'll help justify the fact that you have a solo 401k. And of course, you can't have any full-time W-2 employees working for any business you own or is owned by a spouse, if any. So that would be the expectation, is that you report at least the minimal amount of earned self-employment income before setting up a solo 401k. But keep in mind, if the goal is to make contributions, they're going to be limited to your self-employment income. So if you have $1,000 of wages, right, you're not going to be able to contribute more than $1,000 to the solo 401k. On my 1040, I also have a previous company as self-employed freelancer business doing graphic design and web design work. So you have a previous company. So if the company has already been shut down, it's not possible to set up a 401k for a former business. You would need to do it. You would need to be currently self-employed and going forward to set up a solo. Hopefully that helps. Thank you for bringing the good question. All right. Well, thank you so much, everyone, for the great participation today. We certainly appreciate it. Please continue to participate. All the best, everyone. Take care. Oh, I see one last question came in. I didn't quite get it. We'll answer that one. So if you still do a little bit of self-employment activity, it still continues. And again, no employees working for any business owned by you or a spouse, if any, that would be enough to set up a solo 401k. There's no minimum amount of self-employment income that's needed, right? It's not as if solo 401k plans are only for businesses that are generating a certain amount of income, right? Even a micro business can set up a solo 401k. Well, it comes down to, I mean, how you are accounting for your income at the business level is really a business question. For purposes of being able to set up and make contributions to the solo 401k, you just want to be sure. You just want to be sure that ultimately, when you report your 2024 income, you're going to report W-2 wages from your business to justify those contributions. So in short, that's not really relevant to the discussion about whether you're eligible to set up a plan and or make contributions. Thank you. Thanks everyone. All the best.